The market is not random. Algorithms program charts with mathematical symmetry, meaning the most reliable profit target is often an exact repetition of the previous move. In price action trading, the market constantly seeks symmetry. When a trend establishes a clear direction, pauses, and then resumes, the second leg of the movement is often identical in length to the first. We call this a measured move, and it is the foundation of setting precision profit targets. The core concept is simple: leg 1 equals leg 2. Institutional algorithms are programmed to take profits at these mathematical projections. If you understand where the computers are exiting, you stop hoping for profits and start calculating them. Let's look at the structure of a standard trend. You have a strong breakout, the spike, followed by a pullback, the pause. Once the trend resumes, we measure the vertical height of that first spike to project where the trend will likely exhaust itself. Notice the strong impulse up. This is leg 1. After the pullback, the market resumes. By projecting the height of leg 1 from the bottom of the pullback, we get a high probability target. Note how price hesitates exactly at that level. Why does this happen? It is a self-fulfilling prophecy. Bulls who bought the bottom want to take profits. Bulls who bought the breakout want to take profits. They all look for the same logical resistance point, the measured move. There are different ways to anchor your measurement based on market context. In a very strong trend, or a spike and channel trend, you measure from the start of the trend to the first major pullback. That creates your projection rod. Another powerful form of measured move involves gaps. In a strong breakout, a gap often appears in the middle of the trend. This is called a measuring gap. The gap represents the halfway point of the move. If you see a gap during a breakout that stays open, assume it is the midpoint. Measure from the start of the trend to the middle of the gap. Then, project that same distance upward. This gives you a target where the trend is likely to end. This gap logic applies to time frames from 1-minute charts to monthly charts. The market vacuum created by aggressive buying usually signals that the move is only half done. Do not bet against a trend with an open gap. Now, let's discuss trading ranges. When a market is going sideways, it is building energy. When it finally breaks out, that energy is released. The height of the range determines the minimum target for the breakout. To calculate this, take the price at the top of the range and subtract the bottom. Add this difference to the breakout point. This is the minimum objective. Often, markets will go for 2 times the range height. Here we see a rectangle pattern. The market oscillates between support and resistance. Once the bull breakout closes strongly above the line, we project the height of the rectangle upward. This is where breakout traders will exit. However, context is critical. Most breakouts from trading ranges fail. You need a strong breakout bar, a big body with small tails, to confirm the measured move is valid. If the breakout bar is weak, the measured move is unlikely. Inverted patterns work the same way. A head and shoulders top is a reversal pattern. The distance from the head to the neckline is your measuring stick. When the neckline breaks, project that distance down. Here is a double top. It acts like a trading range. We measure from the high of the tops to the low of the neckline. Once the neckline breaks, the market usually falls for a measured move down equal to that height. Measured moves also apply to smaller patterns, like flags. A bull flag is essentially a small trading range tilted against the trend. The flagpole is the move leading into the flag. We project the pole's height from the breakout of the flag. Here, the strong move up is the pole. The consolidation is the flag. When the trend resumes, we don't just guess. We copy the pole and paste it at the breakout. This gives us a concrete location to sell part of our position. Let's talk about reliability. A measured move target is not a guarantee. It is a probability magnet. In a strong trend, the probability of reaching the target is 60% or higher. In a weak, chopping trend, the probability drops significantly. If a market approaches a measured move target and you see climactic behavior, huge bars, exhaustion gaps, it is time to exit. The computers are satisfying their algorithms. You do not want to be the last one holding the bag. What happens if the market creates a measured move target but fails to reach it? This is often a sign of trend reversal. If the bulls cannot push price to the logical mathematical target, the trend is losing strength. Conversely, if the price smashes through the measured move target with no hesitation, do not fade it. This indicates extreme momentum. The market will likely create a new, larger measured move based on a higher time frame. Complex corrections often consist of two legs. This is the AB equals CD pattern. In a correction, the market drops, A to B, rallies slightly, B to C, and then drops again, C to D. Leg CD is usually equal to leg AB. This AB equals CD structure is one of the most reliable patterns for entering a trade on a pullback. You aren't guessing the bottom. You are waiting for the symmetry to complete before entering in the direction of the major trend. When trading measured moves, you must also look for confluence. Does the measured move target line up with a previous support level? A trend line? A round number? When multiple factors align, the target becomes extremely powerful. One final advanced concept: failed breakouts. If a breakout above a trading range fails and reverses, the market often targets a measured move in the opposite direction. The failed energy reverses forcefully. Here, the bulls tried to break out and failed. The market reversed. We measure the height of the failed breakout range, but we project it down. Failed moves are often fast and reach their targets quickly. To summarize, market movement is based on leg 1 equals leg 2. Use gaps as midpoints. Use range heights for breakout targets. Always watch how price behaves when it touches these invisible mathematical lines. Mastering measured moves removes the emotion from your exits. You stop guessing where the price might go and start understanding where the market structure dictates it should go. Precision wins over prediction. Look for symmetry, measure the legs, and trade what you see.